Hi, it's Eric Nuttall of the 9 Point Energy Fund. We wanted to provide a quick update on 2019 and give you a refreshed outlook on our outlook for 2020. We should be out in the next couple of weeks with a more thorough, detailed analysis for you. Looking to 2019, it was one heck of a year to manage. We had a positive macro backdrop on oil supply. We had continued discipline on behalf of OPEC. But what really commanded the market's attention was demand worries centered around the US-China trade skirmish. The narrative around weak demand growth persisted throughout the year, and in fact, we did see it in the numbers. We did inventory builds beyond what one would have thought initially. Thankfully, as the year progressed, as progress was made between China and the US, whether optically or not, we did see demand improve. And that also coincided with OPEC striking a deal to remove further barrels from the market late in the year, which resulted in a very powerful rally. We were extremely well positioned to benefit from that. We had a very strong end to the year, and we ended the year up about 19%, which was significantly above our index and our peers. And by some analysis, if you look at traditional long-only energy funds, we were actually the top performing energy fund in the world. So we're quite happy with that. Looking to 2020, we're very excited. We believe that we will soon be entering into a multi-year bull market for oil, and the sacrifices that we have all made by holding these energy stocks, which have contributed a lot towards stress levels, will finally be rewarded. In the very short term, we're having to deal with fears around the coronavirus currently, worries that will impact demand specifically in China with jet travel during the lunar season or holiday. When we look at historical precedents such as SARS back in 2003, the impact was short-term and it was modest. Any weakness that we have in oil, any weakness that we have in energy stocks, we view as a very, very good opportunity to, perhaps for those who missed the rally late in the year, to reevaluate the upside in stocks that are trading at a third of their historical multiples and at 15 to 20% free cash flow yields. Barring this spreading into a global pandemic, which, it's possible, but in investing, you kind of want to risk things and go with the most likely outcome. This is an extremely attractive opportunity. We have many holdings that have fallen by 15 to 20% just in the first 3 weeks of the year. So why are we bullish? Why do we think we're entering into a multi-year bull market for oil? We see supply falling, growth rates moderating. And the most important dynamic that's starting this year is that US growth, as a result of continued financial discipline, in addition to technical issues, i.e. wells not improving and in fact deteriorating in their overall performance year over year, we see that contributing to the US only growing oil production by about 700,000 barrels per day this year. So while it's growing, it will be the first year in several where the US is not offsetting global demand growth. And therefore, it means that finally, there's a need for non-US oil producers around the world to grow oil production. Why is that a challenge? That's a challenge because due to the lack of historical investment on long lead projects offshore around the world, we see global offshore oil production entering into a multi-year decline later this year. And that's significant because that's 1 in 4 barrels produced globally. And due to the long lead nature of these projects are, typically cost several $billion and their 4 to 6 year lead time, the ability of industry to respond to a supply shortage is not there. Because if you sanction a project now, you'd have to wait 4 to 6 years before the project actually came online. And thus the burden is really going to fall on OPEC to make up for the gap between demand growth and US growth. Because when we look at non-OPEC, non-US production, so that'd be countries such as Canada and Brazil and Norway, the UKNRC, etc., production there's actually been falling for the past 5 years. And so the burden's really been on the US, but the US can no longer account for total demand growth. And now it falls on OPEC. But the challenge now is when we look within OPEC, there's really only one country that has any semblance of accessible spare capacity, and that's Saudi Arabia. And so they're producing at about 9.7 million barrels per day now. We think max capability is about 11 million on a sustained basis. So that's spare capacity of about 1.3 to 1.5 million barrels per day. That's just over 1 year of demand growth. And when we look at other countries within OPEC, you look at Iran under ongoing sanctions, we look at Libya, the market oil's fallen off $3 to $4 now on a global warm winter. So demand usage was weak. And then this concern about the coronavirus. But we've lost over 1 million barrels per day in Libya just in the past 2 weeks. When we look at Venezuela, the production there continues to fall, and that situation is not getting any better. We've seen within Nigeria force majeure declared by Shell. So the geopolitics, like the world's becoming riskier and riskier, but the market has become more and more complacent about any geopolitical event. So we've completely ascribed zero impact from any further supply losses. So we see a market for the next several years where, so long as demand grows at a normal pace of about 1 million to 1.2 million barrels per day per year, we see the US growth rates continuing to decelerate in the years ahead. We see non-OPEC, non-US production effectively going into decline due to a lack of investment in long lead projects. And we see OPEC where they have very limited spare capacity. And so we're bullish on the oil price. What's exciting is that when you look at the valuations of energy stocks, they today are discounting a long-term oil price below $50 per barrel. And we see oil hitting $60 again later this year, and we have an upward bias on that in the years to come. But you don't have to believe in a higher oil price. You just have to believe in $55 to $60, effectively where we are today, to see very meaningful upside in energy stocks. And so what we simply need is for interest levels to return to the sector. And we think that as the tightness in the oil markets becomes more and more obvious, that you only need even a modest return of capital flows to get a strong re-rate in energy stocks. We have multiple names where we see well over 100% upside, just if they were able to capture a fraction of their historical trading multiples. When we look at our fund, how are we positioned today to benefit from this view? We have a very strong bias towards Canada. Canada remains the area in the world where the sentiment is the worst, valuations are the cheapest, and yet there are many catalysts to allow sentiment to improve. And what are those catalysts? We've seen, for the first time now, major progress being made on 3 significant pipeline projects. When we look at TMX, we have pipeline going in the ground. The Supreme Court just ruled in favor of Canada over the British Columbian government. The BC government's basically given up now for their legal challenges. And so other than the odd protester getting in the way, which I think will be handled, I strongly believe, and we were kind of more bullish than others, we think that the federal government is strongly behind this project. And so that's almost a 600,000 barrel a day project in 2 years coming online. Just recently, there was significant progress made on the Keystone XL project. A presidential permit was reapproved. There's strong indications, or of court filing, in fact, from the pipeline operator that construction will occur in the next couple of months. And that would be in excess of 800,000 barrels per day coming online in the next couple of years. And then finally, more shorter term, we have line 3. There's going to be the final ruling within Minnesota Public Utilities Commission in the next month. So we should have line of sight to potentially almost 400,000 barrels per day coming online around Q1 or Q2 of next year. And so between now and then, we continue to see crude by rail ramping. We see the Northwest Refinery Upgraders, so it's a refiner that will be taking heavy oil. And so we're very, very bullish on Canada. The free cash flow, which is all the people want to focus on now, free cash flow yields in Canada are 2 to 3 times better than in the United States. And as we get closer to the November election, depending on who the Democratic nominee is, we think the risk of the U.S. Energy sector will allow increasing foreign and U.S. funds to come back to Canada. And so just to wrap up, in the here and now, we have to deal with fear of demand destruction from an unknown, the coronavirus. It's a very dynamic situation, obviously. If we look at the closest historical analog, which was SARS 17 years ago, it had a modest and temporary impact on fuel demand, jet fuel to be specific. But when we look at valuations today and how depressed they are, when we look at the medium-term outlook for oil, where U.S. growth rates are in what I'm going to call permanent decline, where global offshore is entering into decline due to lack of historical investment, and whereas you're looking at a 4 to 6 year fix to resolve that, and where OPEC really has limited accessible spare capacity, which only amounts to 1 to 2 years of demand growth, we see the market becoming tighter and tighter and tighter with each passing month. And so as we emerge out of what is seasonally the weakest period of demand, which is Q1 right now, it just happens to correspond with this coronavirus. Once we get past this noise, we see inventory draws increasing. We see the greater probability of funds flow returning back to the sector. And when people realize that you can buy names trading at discounts to their liquidation value, trading at 2.5 times their enterprise value to their cash flow, trading at levels where they could afford to do 15 to 20% buybacks or pay 15 to 20% dividends per year, we see that as extremely compelling. So we remain fully invested now. We had an elevated cash level in December. That money has been completely deployed, given the risk versus reward that we see completely in our favor. And so we're very bullish on another positive 2020 after a very, very strong showing in 2019. As always, if you have any further questions, reach out directly, and thank you for your time.